This week's economic calendar represents a pivotal moment in the Fed cycle, poised to significantly influence the markets for many months to come. The Fed is playing a very delicate balancing act between extremely sticky inflation and a jobs market now showing some reason for concern. We're going to show you how the markets are set up for this week's economic calendar, what will a good or bad number look like, and the likely ramifications to the very precarious balance we now see in stocks. Where did we leave off last week? We had a slew of Fed speakers, the Beige Book, Fed Chairman Powell testifying in Congress. To summarize, Atlanta's Fed President Bostic, the U.S. Federal Reserve is under no urgent pressure to cut interest rates given a prospering economy and jobs market. Well, is the economy prospering? The recent GDP now stands at 3.2%. That's a decline from the prior quarter's 4.9%. Not great, not awful. Is the jobs market prospering? Last week's non-farm payroll indicates 275,000 new jobs created, better than the prior month, but less than December's 290. Again, not great, not awful. But remember, last week we also saw a bleak picture from the other jobs reports, like the ADP. On a year-over-year basis, total payrolls have declined from 5.6% to a current 1.8%. And let us not forget about the JOLTS report. Over the past few years, the number of jobs measured annually has plummeted from a 56% to a current bleak minus 15%. We now look to the last inflation report that will be released on the footsteps of the Fed meeting, and we're going to show you exactly what the markets want to see. But just for a moment, it's important to understand where the market is now. In red, we see the probability the Fed will not cut rates in May. In blue, the chances of an actual Fed cut. Amazingly enough, at the moment, there is nearly a 78% probability they will not cut rates and leave borrowing costs at their current 525 to 550 range. Currently, there is only a 22% chance the Fed will cut rates. I suppose the Fed is looking at those GDP and non-farm payroll reports in the most positive light. But there's more to an economy than just growth. There's also inflation. The Fed reiterated an approximate 2% target before they would consider rate cuts. The last consumer price index left us 3.1%, close, but not for the Fed, still not close enough. There are other crucial reports due this week, and they could spell some trouble. But we're not done with inflation. Following the pivotal CPI, we also eagerly are awaiting the producer price index. This measure of inflation on the wholesale level goes to influence consumer prices. While producer prices have weakened substantially, a surge in wholesale prices could chase the Fed away from the idea of any cuts in the near-term future. But potentially the most troubling news is yet to come. This week, we also have manufacturing data, and lately, that has not been good. The Empire State Index reports the state of manufacturing in New York. While last month's -2 may not stand out as a red flag, the month prior produced a -44. We know from our prior discussions readings of -40 on the Empire Index is associated with very poor manufacturing conditions. The Industrial Production Index is also scheduled this week. Last month's report represents a 3-month low, and the capacity utilization shows us to what extent the manufacturers are actually utilizing their full capabilities. The most recent data was released at multi-year lows. So what does this all mean? Stocks like the prospect of lower rates in a growing economy, for example, declining inflation and economic growth as in manufacturing. Conversely, if we see the opposite, well, I think you can imagine a different outcome. Ultimately, the Fed futures will guide us along the way. In the perpetual struggle between opposing forces, we find ourselves at the crossroads of economic growth versus inflation, prosperity versus indulgence, and scarcity versus value. Armed with the data, we meticulously gather our resources, survey the economic landscape, and stake our claim in the ever-changing world of market analysis.